Hi, it's Don Connelly. This is not one of our normally scheduled webinars. This is, I don't want to call it an emergency webinar, but it's a coronavirus update. I know I've had a lot of calls from people. What exactly should I say to my client? So I'm trying to give you at least some of my thoughts. Nobody knows anything at this point about the future, obviously, but here's how I would carry on a conversation today if I were talking to a client. My overarching theme would be this: this too shall pass. You and I have been through 9/11 and Hurricane Katrina and so many incidents. They all pass, and this is going to pass as well. Nonetheless, let's drill down a little bit and sort of build an argument here. Corona is Latin for crown. And the coronavirus gets its name. If you again look at the spikes in this picture, the surface of the coronavirus is this crown-like thing. That's why it's called coronavirus. This is the 7th coronavirus. Coronavirus is not new. Most of the previous viruses were very harmless. 2 were not. SARS was deadly and MERS were deadly. But this is not the first time we've been down this coronavirus road. Make that point clearly. This one's called, the 7th generation is called COVID-19, coronavirus in 2019. Now the fear is, as I'm doing this broadcast, it is not a pandemic. It may be by the time you listen. An epidemic occurs when a disease spreads rapidly. A pandemic occurs when a disease spreads geographically. It could affect a country, could affect the entire world. So far, it is not a pandemic, but we've had pandemics before, and it makes sense to take a look at how the markets responded to previous pandemics and epidemics. Everything is very uncertain. It is now Sunday, March 1st, 2020. There are about 80,000 cases worldwide of coronavirus. There have been about 1,400 deaths, 95% of those deaths in the same province in China. COVID-19 has now been confirmed in nearly 60 countries. We know that, so it is spreading. But look at some of the scary names. I know you remember some or all of these, not the Spanish flu, obviously, but you've heard that name. Asian flu, Hong Kong flu, bird flu, swine flu, SARS, MERS. AIDS is a pandemic. Cancer is not, because it's not infectious, it's not contagious. A pandemic or an epidemic has to be both infectious and contagious. So let's look at the past results of previous pandemics, epidemics. The Spanish flu happened in 1918. Half the world became sick and 20 million people died. There were 500,000 deaths in the United States. This is by far the worst pandemic in U.S. history. The market was down 25% that year, up 8% the following year. But as in most cases, it's things other than just what we're looking at that are prevailing conditions. World War I was ending up in 1918. So we don't know if it was Spanish flu that caused the market down 25%. Was it the war? There are extenuating circumstances, as there usually are. Asian flu happened in 1957. 1 million people died, 70,000 in the United States. 1957, the S&P was up 24%. The following year, up 2.9%. It weathered Asian flu. Hong Kong flu, 1968, 1 million deaths, 30,000 plus in the United States. Again, the S&P up 12.5% that year and 7.4% the following year. So again, we're weathering all these storms. Bird flu, that's a much more recent one. That was 1997. There wasn't one case in America, but if you read the papers, listened to television back then, you'd think it was all over the world. It wasn't even here. The Dow was up almost 33% that year, up 28% the following year. Swine flu, much more recent. There were 22 million cases in the United States, 4,000 deaths. How did the market handle it? Up 23.5%, 12.78 the following year. We have to hope that we've learned from previous pandemics and epidemics how to deal with this. So far, in the United States, exposure is relatively low. Let's hope we've learned enough to stay ahead of that curve. Now, SARS was 2003. There were only 8,000 cases of SARS, but there were almost 800 deaths. The death toll was extraordinary. The market was down 13% in 2003, but again, it was a tech bubble bursting. It was up 20% in the next 3 months. So that was when the tech bubble burst. What's responsible, SARS or the tech bubble bursting? MERS, there were only 500 cases of MERS, but nearly a 40% death rate. Again, the market up 13.5% that year, to almost 30% the following year. So we have weathered these storms before. Calamos just did a study, which I found very interesting. They went back and looked at the 15 previous academics and pandemics. Now, short-term, stocks fell. Some cases, they fell dramatically. But after 3 months, on average, after the last 15 episodes, stocks were back to normal stocks returned to the positive after 3 months and kept improving after that. So on average, after these epidemic, pandemic outbreaks, stocks were up roughly 10% 12 months later after an outbreak, and that's in line with the historic yearly performance of the market. So we weather and we go on. And the same with coronavirus, this too shall pass. No one knows how deep it's going to get, how severe it's going to get, but it's going to pass. But let's not tell your clients, don't just look at the outbreak. Don't just look at coronavirus. They're a health emergency. They get overshadowed by other things. When SARS broke out, as I said, it was a tech bubble bursting. When the swine flu broke out, that was the end of, that was the Great Recession. You know, the late 2000s, early 2010s, that old 2008, 2009. That coincided with swine flu, so we don't know. There are always extenuating circumstances. So, can we make a conclusion? Yeah. There are no conclusions. That's the conclusion. You can't make a definitive conclusion about the effects of the pandemics on stock market performance. Don't let anybody tell you you can. The market reacts unpredictably to the unknown. We all know that. So events like coronavirus should not be examined in isolation. You got to look at other prevailing market conditions. And look at the market now. Unemployment less than 4%. Stock markets at all-time highs. Things are doing really, really well. So when the market goes down, is this we're at the top and it's nervous investors taking profits? If it hadn't been swine flu or coronavirus, it would have been something else. So here we are, you know, the Dow where it is. People are taking profits, running the sidelines. I get that. But the market conditions overall are very, very strong. Here's something you never hear about from the mainstream media because it's not sexy. Every single year, 10% of American people get the flu. About 100,000 are hospitalized, and on average, 36,000 Americans died of the flu. In 2018, more than 80,000 Americans died of the flu. Why don't we know that? Not newsworthy. It's not sexy. It's not high voltage in terms of the media. So they don't talk about it. Now, investment terms, we got to remember all this reaction to coronavirus is not the reaction to coronavirus itself. It's the reaction to the measures being taken. Airlines are canceling flights. Cruises are being canceled. You know, Disney stock's getting pummeled. American Airlines, Delta. Companies are suspending operations in China. These are temporary things. And when these are lifted, the temporary thing is over. So what do you do now? You go right back to the basics. You talk about long-term investing. Short-term gains and short-term losses belong in the hands of the day trader. Your clients are not day traders. So the reaction isn't to the coronavirus, it's to the preventive measures being taken to curb the coronavirus. So probably a correction was overdue, probably. Markets at all-time highs, right for a pullback. Hadn't been the coronavirus, it would have been something else. Tell your clients that. So what should investors do? Remember, we've been through this before. Scares do not exact a permanent impact, so avoid doing anything rash. Your advisor, your advisor will tell you if your plan's on track. Talk to your advisor. He'll see it, or she will see if you got the right mix of assets for your goals. Maybe some of you have been in the market, some of your clients have been in the market so long, they're overweighted in stocks because they've had a great bull run here for years. It's time to rebalance, possibly. That's the whole role of the financial advisor. So don't panic, think long-term, and talk to your advisor. Those are my 3 pieces of advice I've been telling clients. So what we're saying is strictly short-term. Mr. and Mrs. Client, we're pushing a beach ball underwater. The further down it goes, the higher it goes, and we let go. The New York Stock Exchange is 250 years old. The S&P is old. Dow back to 1896. NASDAQ back to 1970. Every single time the market's gone down, ever since in the beginning of time in America, every single time the market's gone down, it's come back. That's undeniable. Every single time it's gone down and come back, it's gone on to set new highs. It's undeniable. And a lot of people lose money in the stock market. That's undeniable. Well, if we know it's going to come down, we know it's going to come back, why is everybody going to lose? Because fear is a bigger emotion than greed. Understand, as the market goes down, we're pushing a beach ball underwater. When we let go, the further down we push, the higher it's going to go. Is it going to happen again? I don't know, but it's never failed to happen in the past for over the last 250 years. Tuna fish is on sale. Invest your money like you shop. If tuna fish is $1.50 a can, and mom and dad go to the store Saturday morning to buy tuna fish, it's marked down to 99 cents a can, they're going to buy 5 or 6 cans of tuna fish. It's the way they shop, you shop, I shop. We all shop that way. As a financial advisor, you're in the only business in the world, you slash your prices, people run away. You market prices up to all-time highs, people throw money in over the transom. We've got to think of investing their money just like they buy tuna fish. You buy things when they're on sale. These are just words. Market soars 100 points. Market plunges 900 points. Coronavirus causes the market to plunge. Plunge is just a word. Now, why does the press sensationalize everything? Because nobody listens to reasonable discourse anymore. And social media has taken that to extremes. Twitter is no more opinion on Twitter. All there is on Twitter now is selective outrage. So if you want to get someone's attention, you're going to be louder and more brash. and you got to scream with this high voltage energy. And that's what they're doing about coronavirus. They're making it into this, now it may be a big deal at some point, but they're making it into this enormous deal. I heard one talking head say he predicts, it's a newscaster, 65 million deaths in the next 18 months. We're now in August 2021. Those are just words. Mr. and Mrs. Klein, how would you feel tomorrow if you got an elevator? It didn't say up or down, it said soar or plunge. How would you feel? You'd get off, you'd be scared to death. Those are just words. Soar means up, plunge means down. Well, the market goes up and down. That's the way the market behaves. Take a stride in your office. If the Dow's at 25,000, your office is 25 feet wide, take a step. Your step is 2.5, 3 feet. One step in your office is like a temper. Look back. Is that like I've covered much of this office? I haven't gone very far. It's one step. That's like a 10% correction. Put this thing in perspective. It's just one stride across a big office floor. So I'm going to make this very quick. In conclusion, stick to the basics when you're in doubt. Have a long-term time horizon. If you can afford to do it, invest money on a regular basis. Don't try to time the market. Be properly diversified. When you're talking to someone who's got an account with another advisor, ask them if they're happy with their portfolio. If they say they're happy, you can tell them they're not properly diversified. Because to be properly diversified means to own something that makes you uncomfortable. So the long-term time horizon, don't try to time the market. You got to be right twice when you market time. It's impossible over time. Be properly diversified. They have a realistic time horizon. These aren't your prices today. These are somebody else's prices. And of course, set realistic expectations. And that's your role. Most of you listening to this call right now don't manage money. You manage expectations. The last thing I want to say, I urge you to become a member of Don Connelly 247. There's a coupon code Corona10, give you a 10% discount on a platinum membership. And I want to sell you here a little bit. As a platinum member, we're nearly 200 videos, and probably more than 200 videos and audios on Don Connelly 247. And we send out a weekly focus, send out an action plan. I do a monthly newsletter. We have hundreds of newsletters you can read. Go back in the archives. I've got webinars for the last 15 years on the subjects ranging from volatility to everything. We've got a webinar library. And of course, I'm available for coaching free with Ask Don. Platinum members can send me a question. I answer my emails. You send me the question by email. I'll discern the answer. I'll share it with other people for the good of the group, and I'll give you your answer. So that's a very quick update. That's all I wanted to say. But understand, this too shall pass. If you haven't done so, go to the store, purchase the Litany of Disaster. From 1950, when the Korean War broke out, to today, there have been almost 60 probably major disasters where every time that the press said, this time it's different. From the Korean War to Eisenhower's heart attack to Vietnam in the 60s. Just think in the 60s, the deaths of Bobby Kennedy, Martin Luther King, John Kennedy, Malcolm X. Think of that period. Nixon resigning in the 70s, 14% inflation in the 80s, Reagan being shot in the 80s, the Achille Lauro, the Gulf War in the 90s, 9/11, Katrina. We've gone from 200 to 27,000 in the face of some of the worst news ever. And as egregious as all those events were, those too shall pass. Coronavirus shall pass. I hope that helps. Thanks for listening. Get on your phone now. I know one thing about clients. They don't want to call you in times of crisis. They want you to call them. Get on the phone, get knee to knee, bring your clients up to date, and cement your relationships. Thanks for listening.